and a wonderful welcome to everyone in 2026. We hope you've had a wonderful Christmas and a very relaxing holiday and New Year break, and starting the year off with some good, I suppose, New Year's resolutions for everyone listening. Today, we're diving into what's happened in sort of the last quarter of 2025 and as we enter the 2026 market outlook. My name is Joel Kieran, sitting here in Perth with my colleague Amber Dawson, and as well the regular Will Cant over in New South Wales. And for the first time, we've also got our newest financial advisor to the Ally Wealth team, Ben Wise, in Sydney as well. So as we've closed out for 2025, we're into sort of the first weeks of 2026. Markets have once again demonstrated that the remarkable resilience, despite probably some lofty valuations and some political uncertainty around the world. Today, we'll walk you through what's happening over sort of the past quarter and what's driving us through our investment decisions and our outlook for 2026. So first up, Will, why don't you take us through what's happening in global markets and through to the US?
Thanks, Joel. And yeah, I think you hit the nail on the head there. A lot of political uncertainty in the world at the moment, it seems, and definitely in the final quarter of 2025, we saw a lot of that happening as well. But really, markets across the globe in the last quarter of the year had quite strong performance, even despite clear, cautionary tales in the geopolitical space. And there were a few cautionary pockets in the market, as there always is. But overall, quite a strong quarter. Several themes really stood out over the quarter. So gold surged to new highs as investors sought safety from rising government debt, as people always do when they go to invest in gold. It is a stable investment, a lot of people like to think. We saw those massive lines, I know at Martin Place in Sydney, with everyone lining up to buy gold. Usually when you see that, it means it's too late. But that was a very common theme for the final quarter of the year. We also saw US mega cap tech lagged along global equities, while US small caps, Europe, and emerging markets really outperformed. Healthcare was really the best performing global sector as investors really looked for defensive stocks, and here in Australia, materials led locally. Valuations do, though, remain quite elevated. So markets, are priced for good news, but could still be quite vulnerable to, policy shocks, earning disappointments, and especially with the more expensive US equity sectors. Despite these risks, though, the past year, again, defined by resilience, with investors really rewarded for diversification and disciplined positioning with their overall portfolios. We saw a few bumps throughout the year, but yeah, overall, it was a really, really strong year for markets. Over to the US. The US economy remains the key driver of global sentiment, but it is entering 2026 with mixed signals. Growth and inflation are a really key factor to be considering for 2026 in the US market. Inflation is still well above the Federal Reserve's target of 2%, sitting at about 2.6 to 2.7% at the moment. We all remember approximately a year ago when Trump announced his tariffs, Liberation Day, I think it was in March or April. They really pushed input costs higher, and these effects are really continued to expect to be prevalent through 2026 as well. The labour market has softened, but it's difficult to interpret due to the extended government shutdown that we saw last year and shrinking labour supply. When we look at policy in the US, the Federal Reserve has cut interest rate 3 times to about a 3.5 to 3.75% range. And both President Trump and financial markets are expected further cuts. But if you've been keeping up with the news, there's a bit of a tumultuous relationship between Trump and the Federal Reserve at the moment. So we'll keep our ears to the ground there and see what happens. When it comes to market leadership, US earnings growth in 2025 was dominated almost entirely by the AI mega caps. AI investment remained really, really strong, but really questions about the monetization of it, sustainability, capital expenditure, and the valuation of these companies is becoming a lot louder. Credit spreads as well remained extremely thin despite rising default rates, which really is a classic late cycle indicator. Overall, the US remains strong, but is becoming more and more increasingly fragile. We saw it a little bit last year with some volatility in the US market, and it is something to keep an eye out for. So investors are really starting to become more sensitive to policy surprises and earning disappointments. So again, the US market for 2026 could be quite strong, but we definitely want to be cautious here.
Thanks so much, Will, for giving us an update on the US markets and more globally. Looking now to Europe and the UK, I suppose there's some common themes that we see run through. But starting off with, there was quite a broad improvement through Europe in late 2025. And this was helped really by, there was some rising real wages, improving consumer demand, and the fiscal support was really handed out in key countries such as Germany. There are still some risks though, and they remain in areas such as the government facing pressures to balance that spending versus the debt sustainability. Again, the tariffs are really wide reaching. So there's tariff uncertainty still through Europe, and it continues to weigh on business confidence. And then also some political fragmentation, making consistent policy execution quite difficult. The UK remains stable, but slightly sluggish, with some moderate growth expected into 2026. Looking then to Asia. Asia has been a standout and continues to be a bright spot, but the outlook varies region by region. Looking to trade and growth, Asian export growth has slowed because it was, front-loaded earlier in 2025, and there is certainly some tariff uncertainty from the US still playing on their minds and remains a key risk. There is a major offset though, and that is the AI-driven demand. Asia is now deeply integrated into the global AI supply chain, and it has strong demand for, high-performance chips in Taiwan and South Korea. There's growth in data centers, there's continued investment momentum in Japan, and China's long-term pivot towards advanced manufacturing and self-sufficiency has really seen that hold true. Then to China, China is avoiding short-term band-aid stimulus, and they're instead focusing on consumption, high-tech manufacturing, reduced overcapacity, and also strengthening long-term economic resilience. The trade flows have shifted really firmly towards emerging markets and reducing geopolitical risks and supporting China's currency stability. Overall, Asia offers selective opportunities, particularly in technology, manufacturing, and markets with really strong fiscal positions. Over now to Ben to talk about Australia.
Thanks, Amber. Thanks, Will. Over to Australia, our local market. I think the key term that comes up here again is resilience, but I think that only tells a part of the story of what we've seen here. If we look at it from a macro level, there are probably four main things to consider. Inflation has driven slightly higher, primarily off the back of energy and other prices in the market that they're outside the control of the individual consumer. We've seen the labour market weaken. Jobs and hours worked are slowing. Unlike the US, we're actually seeing the RBA looking at possible tightening of interest rates over the next 12 months. And fiscal policy is relatively neutral. The government debt levels remain low compared to our global peers, but is still something that needs to be monitored. If we then turn to equities, the ASX has had another great year pushing to record highs, but there are still serious questions about earning growth, particularly around the banks and the miners, which drive a lot of the growth of our equity market here. What this does highlight is the value of stock and sector selection in 2026. Rather than taking a broad index approach, we still are very strong believers that selecting the right stocks and the right selectors will provide the better outcome for you over the next 12 months. If we look at property, once again, we expect property to be, a two-phase cycle. In the first half of the year, we expect strong momentum to be driven by potentially rate cuts that are flowing through, income growth, tighter supply as homeowners sit on the fence, and a major demand shock from the expanded first home guarantee scheme, which we don't see having had the take up as expected as of yet. From July to December, we see a little bit more moderation. Affordability ceilings start to be reached, especially in Brisbane, Adelaide and Perth, and we expect units to outperform houses in several cities and rental markets to remain extremely tight. This is a long-term trend. We still see greater value in houses where the land exposure is more significant. Back over to you, Joel, for an outlook on 2026.
Thank you all. So I suppose where I think I would like to just sort of close out the sort of general synopsis of what's happening around the world and just sort of recapturing sort of everything that we've been saying here. Global growth sort of outside the US is beginning to stabilize, and inflation generally is gradually easing in most regions around the world. AI continues to be one of the, line dominating headlines across the world, and that supports earnings, particularly in technology heavy markets. Fiscal policy as well in Europe and parts of Asia remains as well supportive. Where I guess we see potential risks that happen and going forward into 2026, and comes back to that elevated valuations across most global markets. We start to see valuations at record highs as well. Slower growth around exports into Asia. Credit markets around the world are starting to show as well in late cycles as well. US uncertainty around the political and policy front as well is, I suppose, as well as a risk, and as well with geopolitical tensions that are happening around the world in lots of different environments. How we're looking to position portfolios going forward into 2026, we still like to continue to favour our global diversification over concentration. So we like to obviously spread the risks, make sure we're not having all of our eggs in one basket, having a good select preference towards quality companies with strong balance sheets, selective exposure through emerging markets, having real exposure towards things such as gold, such as resilience tools there, and a strong disciplined long-term approach. So it's always a good time as we're entering into 2026 to have, I suppose, a good view of the portfolios that we're looking at and seeing how they're going to play a role going out throughout the next 12 months. So in summary, it now is a good time for, I suppose, all of our clients to get in touch with, I suppose, your local Ally Wealth financial advisor, to go through, review what your goals, what your aspirations, what the sort of outlook for 2026 is going to look like for you on a personal level, and as well making sure that we're staying positioned and well allocated towards a successful 2026. We're here to obviously help you stay informed and stay on track and make confident, positive decisions for 2026. Thanks so much for tuning in, and by all means, now's a good time to reach out and book in a meeting to plan for 2026.